Most people don't overpay taxes because they made a mistake. They overpay because nobody ever explained how this works. And I want to be really clear. I'm talking about good savers, people who maxed out their 401k, people who followed the rules, people who did exactly what their advisors and their employers told them to do. The issue isn't about effort. It's understanding how retirement income is actually taxed. When you're working, taxes are simple. Money comes in from one place, your paycheck, taxes come out automatically. You don't decide where income comes from. In retirement, you do. Every dollar you spend is a decision, and every decision has a different tax outcome. In retirement, taxes are no longer about your tax rate. They're about your tax location. This is why 3 people with the same income, same age, same deductions have 3 completely different outcomes. Let's say you have a single retiree age 65. They receive $50,000 per year from Social Security, and they need about $150,000 of total income to live comfortably. That means they need about $100,000 from their portfolio. Same person, same lifestyle, same spending. Now, in the first scenario, all $100,000 comes out from a traditional IRA. That $100,000 is ordinary income. It stacks on top of Social Security. As income rises, more of the Social Security becomes taxable. So $50,000 of Social Security isn't really $50,000. Some of it is now pulled into taxable income. So one decision didn't just create $100,000 of income, it dragged more income with it. For a retiree 65 years old, taking the standard deduction with that $150,000, including that $50,000 of Social Security, you could expect to spend in federal taxes plus or minus $25,000. Now, our second single 65-year-old, their $100,000 additional comes from a brokerage account. Now, only the gain is taxable, and it's often taxed at capital gains rates, not ordinary income. So instead of adding $100,000 of income, it's less. And let's say in this scenario, it's $50,000 worth of gain. Same spending, much less income showing up on the tax return. And in this scenario, with your $50,000 of Social Security and $50,000 of capital gains, you're looking at about $4,500 worth of taxes plus or minus. That is a tremendous difference just based off of tax location. And now our third single 65-year-old takes $100,000 from a Roth. The IRS doesn't see any of that as taxable income, assuming that you have followed all of the Roth rules, meaning you're past 59 and a half and you've held those assets for over 5 years before spending it. Now, all you're showing on the tax return is your $50,000 of Social Security. With the deductions, our third individual owes 0 taxes. So in one scenario, we owed about $25,000 worth of taxes, another about $4,500, and the last one 0. Nothing about their lives changed, only the bucket change. And most people don't choose to be scenario A. They just drifted into it. They saved pre-tax for 30 to 40 years. They retired with the most of their money in one bucket. And that happens all the time because we are set up in our corporations today to just automatically draft savings from our paycheck, and hopefully our employer matches it. And it's easy, and you get that tax deduction, and all of a sudden it just builds up. And I see all the time where 90+% of people's assets are sitting in those tax deferred accounts. And tax deferral feels really good early, but concentration creates pressure later on. The problem wasn't created in retirement, it was delayed there. Now let's fast forward. Once we hit RMD age, and depending on your birth year, that could be 70 and a half, it could be 73, it could be 75. Most retirees don't need more money, but the IRS requires it. And as we've talked about in previous episodes, spending starts to slow down generally 5 to 10 years after retirement. So the IRS says you need to take more and more of it, but our lifestyle says we can pull back and we need less. It doesn't match up. Let's go through an example here. Okay, we got a couple here, 60 years old, planning to retire at age 65. Let's take a look at our example. We have a 60-year-old couple retiring at age 65, needing about $154,000 worth of income. Their portfolio is at $2.5 million with $2 million in their 401ks today. As you can see in our income laboratory software, their income stays level and works exactly how they want it to until they hit RMD age. So at RMD age, their monthly withdrawals jump from $12,900 to $14,816. As we've talked about in the past, most retiree spending is the most significant right after you retire. That's when you do your trips, your large purchases, you name it, and it slows down. However, if you don't have your tax deferred accounts under control, this is what happens. And this is what happens frequently is now all of a sudden RMDs are controlling your life, your investment, as well as your taxes. Just over $20,000 of taxes per year that spikes to well over $100,000 later in retirement. And it was deferred. And that extra income doesn't just get taxed. It affects everything else tied to income. Medicare premiums are based on income from 2 years ago. So a forced withdrawal today can raise healthcare costs years later. That's when people say, I don't understand why this got so expensive. That's why guessing year by year doesn't work. You need to see your future retirement laid out in front of you by working with an advisor so you can make the best choices. We use Income Laboratories Tax Lab to review all the different possible combinations that we can lay out your tax strategy into the future to understand how much total taxes you may owe, how to increase your total net income, and what it means for the legacy that you're leaving behind to the next generation. Now, because in our example, we were solving for $154,000 worth of income, what I'm really looking at here is which one generates the most amount of income left over. And in that scenario, it's doing Roth conversions below. And in that scenario, it's filling Roth conversions up to the IRMA bracket 2 premiums. So it's controlling, saying we're going to pay a little bit extra, but not going into the next tier, raising those future healthcare premiums even further. So what does that mean? Well, comparing Roth conversions versus a distribution strategy using taxable, tax deferred, and tax free, our average tax rate in this scenario goes down by 6.1%. Total taxes are reduced by $1 million, and our net legacy goes up by $875,000. In our scenario, by starting conversions once we retire, we're definitely increasing our total amount of taxes for the first 15 years or so, but later on, we're done paying taxes, and as you can see, if we hadn't done that conversion, the RMDs are pushing the taxes well over $150,000. That's how important having a plan can be. And everyone's plan is going to be different because everyone's scenario is different. The goal isn't to avoid taxes, it's to avoid regret. So the question isn't whether you'll pay taxes, it's whether you'll pay them accidentally or intentionally. Thanks so much for spending a few minutes with us today. Retirement taxes can feel confusing, especially if no one's explained how all the pieces work together. If you'd like help building an intentional tax strategy, one that helps keep more of what you work so hard for, you can reach us at info@legacyascent.com. Thanks again, and we'll see you next time.